Crypto markets slipping again today. I don't think that's particularly unexpected. We're going to go into exactly why in just a moment. We're also still awaiting the reopening of the US government, which I have an unfortunate theory which suggests that that might actually be a blessing in disguise. But first of all, let's kick this off by looking at Bitcoin prices. Currently trading at $103,291. That means we have cooled off from the highs that we put in yesterday to current pricing of about 4%. We'll call it 4% here on the Coinbase spot chart. Lows were at just over 4.5%. Not particularly surprised about this. As I spoke about in my last video, a lot of retail would have jumped in optimistically on these green candles. They would have jumped in on the news data from Trump's tariff dividend, his $2,000 stimulus check, and also on the clearing up of the US government shutdown situation. Jumped in on too much leverage, and then as prices cooled off a little bit from that, profit taking perhaps, just natural ebb and flow of the markets, the down move gets further accentuated by those positions becoming liquidated, i.e. forced to sell on the market. You can see this is shown in the data, in the liquidations data. Over the last 24 hours, nearly $400 million worth of long liquidations. You can see that there just above my head. And just $76 million worth of short side liquidations. And out of those as well, in the last 4 hours alone, in the last 12 hours alone, $180 million worth of long liquidations. Nothing unexpected. And for what it's worth, we are still in an uptrend from those lows that we put in back on the 4th of November. If we just draw that in, we call that the low there. High here, higher low here, just by the skin of our teeth. I remember reporting on that at the time. We'll nullify that high there because we put in another higher low here, so it doesn't matter for the trend necessarily, and then a high here. And as we've just bounced a little bit, we'll call that the higher low as well. So the trend is up, at least for the time being, from those lows that we put in back on the 4th of the month. Like I say, primarily driven by liquidations, or at least the extension of this was driven by liquidations. Nothing massive has happened to turn that around. Potentially some jobs data, which I want to talk about more in just a moment, but just another reminder that it's very hard to trade news events as they happen. You've got to be pretty sure that you've heard some news that is going to be market moving before the rest of the market has heard it, and statistically the odds of you doing that are close to absolutely nothing. Really important to try and steer clear of the risk in these situations. And in practical terms, what the risk is everyone else that also read the news like that jumping in on leverage, and we get a situation like the one where I just described, where prices pull back naturally from that because they have to at some point, and then that move gets further extended because of liquidations from all those other people, like hopefully not you, who jumped in on too much leverage and had themselves liquidated out of that situation. So this jobs data, so we have another ADP report which has come out very recently, reporting another 4-week employment average coming in at minus 11,000.25 jobs. So not good employment data. As we know, while the government is shut down, the Bureau of Labor Statistics is also shut down. That means that the Fed doesn't have the core employment data that they are accustomed to be making decisions on monetary policy based on. Okay, so they will make decisions on monetary policy issues such as the base rate. So we now have a base rate which is somewhat elevated, 67.9%, we'll call it 68%, somewhat elevated yesterday, and that is the percentage chance of another 25 basis point at the December FOMC meeting. A quick refresher, risk assets like reductions in interest rate. So this is a high or higher than neutral percentage chance of a 25 basis point rate cut. That means the base rate set by the US Fed will be reduced by 25 basis points. That is usually good for risk assets because it means that investors are not incentivized to hold their assets in hold their assets in yield-bearing instruments like bonds, holding money in the bank, etc. They are incentivized to put that money into risk assets, which includes equities like the S&P and crypto more recently. So we like reduced interest rates. The problem is that I can see coming from this, and we have spoken about this briefly before, but right now okay, the Fed is relying on data from two private sources. One of them is ADP, which is the report that I just mentioned now. Here it is. And the other source is Challenger. So the trend of both of those data sources has been down, which is not good. That is further incentivizing the Fed to reduce that interest rate. But the problem is when we get the eventual end to the government shutdown, I think in the moment that is going to be bullish because markets don't like uncertainty. They don't like moving in the dark. I think Fed Chair Powell has described making monetary policy decisions with the Bureau of Labor Statistics that is currently shut down. Without that, it's like driving in the dark. Okay, so they're drawing on sources that they are not generally drawing from, and these sources are incomplete. So Challenger and ADP. I think when we get an end to the government shutdown, that is going to cause an initial pump on the markets because it is an end to an uncertain time. The problem is we've now got Bureau of Labor Statistics data reports, particularly for employment, missing from September, October, and November. So looking at the timeline that we've got right now, it's looking like the government will open in the next few days. And it's looking like we're going to get those three key data reports, key jobs data, employment data reports for the last 3 months, all out in quick succession. And based on the scheduling of the next Fed meeting in December, we're going to get all of those data points out before that meeting. So that is a pretty unusual situation where instead of making the call based on one data point, i.e. the data for the last month that's just happened, they'll actually have data from the last 3 months, i.e. a 3-month trend, a 3-month average to make this call on. And if we are trusting the private sources, ADP and Challenger, it's not looking like that data is going to be good. So this could go either way. But as I spoke about before in a previous video a couple of weeks ago, when we do finally see the backlog of jobs data coming out all in quick succession, that could actually cause quite a shock on the market. Now, best case scenario, that's actually good data. Best case long-term scenario, that's good data. It balances out some of the negative data that we've been seeing from ADP and Challenger. That would lower the chances of a rate cut at the next meeting, which would be potentially short-term bearish for risk assets. But I think the alternative to that is potentially much worse, at least for equities and risk assets as a whole, which would be negative data, a downtrend over the last 3 months from those data points that we've missed, which would start looking like we're going into a recessionary environment, which, to be honest, how you think about that as a crypto and particularly a Bitcoin investor is kind of in the balance. Historically, we would have thought recessionary pressures, particularly based on monetary policy, right, centralized government control of the economy, a recessionary environment for that would potentially push you on the bullish side to Bitcoin historically, because it's essentially a hedge against that, right? It's a move to a new financial system that is not controlled and not mismanaged by government. But more and more we've seen Bitcoin behaving like a risk asset, particularly as more institutions get involved, more businesses get involved that buy Bitcoin on their balance sheet, hold it on the treasury. And I think where we are right now, recessionary environment wouldn't be particularly good, at least in the first few months for Bitcoin and for crypto. So really, I think first thing that's hanging in the balance, right, for the markets right now, what we're waiting for is just an end to the government shutdown, because it's an end to the uncertainty that we've been seeing. But trying to think 2 or 3 steps ahead here, I am concerned about what happens when we get the release of that backlog of data, that backlog from September, October, and November in the form of employment data from the Bureau of Labor Statistics in the US. So right now, not particularly upset about this pullback. Okay, we knew it was coming. We knew that the market was in the moment over leveraged for that. And this is just natural ebb and flow, right? We're very accustomed to seeing this. Right now, still in an uptrend from those lows that have been put in. I think the market is still, broadly speaking, optimistic about an end to the government shutdown. And that is kind of the first piece of data that we're waiting for. But do be aware, there is danger ahead down the road. And the next most important thing after the end of the government shutdown, if we do get that, is going to be the release of employment data from the last 3 months. And it's going to be ultimately how the Fed digests that at the December meeting. So plenty to pay attention to, plenty to watch out for. Right now we're looking okay. Let's just take a look at where the liquidation levels lie right now. I'm going to give that a quick refresh, hopefully a quick refresh. And we can see that. Moment here. Okay, currently on the daily cumulative liquidation risk, we are skewed to the upside. That means that there are more shorts in the market right now. And if we zoom that out to the 30-day, same story, I believe that we've been seeing. Okay, yeah, so we're about $12 billion worth of cumulative short liquidation risk to the upside. That's kind of where I'm looking at this going, okay? I think if we get the announcement that the US government has reopened, initial pump on that, but do be aware we do have a big backlog of jobs data to come out, which absolutely will affect the Fed's decision making at the December meeting. That's just what I'm looking at right now. As always, not financial advice, purely my opinion, purely shared for entertainment purposes. But thank you so much for watching. Plenty more to come. Catch you next one.